with the margin debt and unemployment, like when this falls, it is insane. Like because
Oh,
it's
it's
going to
gonna be
fall through the floor.
spectacular.
It's going to
Yeah.
fall through the floor.
But here's the deal: when it falls,
Goose pimples.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Good morning, dude. You've got your Corvette going on or whatever over there. I like it.
Oh yeah, no, this is one of my masks.
Okay, I just assumed it was heater issues.
I'm ready to rob this podcast. All right, so I want to kick us off today, Doogles, with a quick, important question for you, and I'm going to pull up some video. So I've really been wondering how I can quit my job and make money from home. Do you have any suggestions for me?
That's the full question?
That's the full question.
And am I answering how one could do it? Should one do it? Should Skippy do it? Does Skippy have skills and talent to do either his job or something at home? What question am I answering?
Just like, let's say I wanted to make I have $500. I wanted to make like $20K a month. Like, you got any ideas for me?
Oh man, I think it gets into understanding like your own risk tolerance and financials. And
all right, I'm gonna rudely interrupt because I want to have that conversation about when I like take my sabbatical or move on to start my own company. But right now, I'm just joking, and I want to play a great video for you. We're gonna try this on the pod.
Hold on. What was this? Are you catfishing me?
Here we go.
So how do we make money from home? For starters, this is not a sponsored video. We just get this question all the time, and honestly, the answer is really simple.
So basically, I just trade stocks on an app called Robinhood, which I left a link in our bio if you want to check it out. It's free to download, free to sign up. They actually give you a free stock, so they're paying you to sign up. But again, not sponsored. And I know trading sounds intimidating. Here's my strategy in a nutshell. I see a stock going up and I buy it. And I just watch it until it stops going up, and then I sell it, and I do that over and over, and it pays for our whole lifestyle. If you're wondering how much you can make doing this, in this month I turned about 400 into 14,000, and in this month I turned less than 1,000 into 20,000.
And honestly, my favorite part about this isn't even the amount of money you can make, but just the fact that we don't have to go to a 9-to-5 job.
Yeah, we can focus on things that we actually enjoy doing. So if you have friends that like want to make money from home, you can tag them or send them a link. Or if you make money this way, share it in the comments so other people know like there's more people doing this now.
Just a couple gems. So this is from TikTok investors or something, right? So first of all, they go out of their way to say it's not a paid promo. Then they tell people what Robinhood is. Then they have screenshots that says he turned $400 into 14,000, and I think he said like $500 into 20,000. That's their typical month.
Is there a way to display a facepalm emoji via audio?
I cannot even tell you, like, if this does not signal that the market is crazy overvalued and people have no clue what they're doing, I don't know what does. It's the funniest thing I've seen this week.
I love that video because it's like when you find the epitome of a thing, it brings us clarity. And I agree that when you combine that with we're going back and forth. I don't know, was it like last week or the week before around like margin debt. So like debt levels in general, but also specifically margin debt. I know you came back to me with some like quote unquote witty response that was like, debt only matters when everything goes down. Right. Yeah. But when we all know, everybody knows, even the people that are calling this a bull market, like the start of bull, I think everybody knows that things have got to, they have to correct.
Doogles, that guy doesn't know. That guy doesn't know. That guy thinks...
When I say everybody, I'm not talking about that guy. That guy is not part of everybody. Let's be clear. Like something's going to drop at some point, and we're at record margin debt levels. And I feel like that guy's probably his $500 was actually on margin with Robinhood.
Oh yeah,
absolutely. And now he's like, I'm at 20 grand. What can I turn 20 grand into? That's going to become millions. So let me just get out more margin. It's crazy. Like it's that man is what scares me.
Yeah, and it should, right? And so I'm gonna hit your next quiz item is do you know what was the best predictor of stock performance year to date? You have any idea?
No idea.
The price per share. So we can talk in a little bit about why the price per share means absolutely nothing, because whatever your market cap is, you pick a random number to divide it by, you create the number of shares. And so you could effectively hit your share price. But
is this the small cap? Is it because like small caps are taken off? Is that basically what you're trying to?
No, it's not even small cap.
Oh, not even market cap, just price per share.
It's not. It's price per share. I'll send you this. James McIntosh, let me get the name right, in Wall Street Journal, had an awesome article this week, and he broke down. He did an analysis of best performing stock, basically to prove the insanity right now. And stocks that are performing best are simply basically priced less than $1, followed by stocks that are priced between $1 and $2. And again, absolutely meaningless. That doesn't mean the company's small. That doesn't mean the company's large. It probably means the company had a troubled past, and we can talk about GameStop and everything else, the craziness that happened there this week.
So let me jump in. Double Dutch. I see why you say it's meaningless, right? Because it doesn't have anything to do with fundamentals, but it does have to do with the psychology of the market and the people that are in the market, right? So it's meaningful at the macro level for what's happening in the market, because your people are logging into Robinhood, probably forgot their password, had to go forget password. No offense to those people. People are logging into their Robinhood and they're saying, like, I have $16. How do I get the most shares? And you find the thing that you can buy the most shares with, right? Or you do a mental math where you're like, most stocks are at $20. So if this thing that's 20 cents goes at $20, now I'm at like 50x. So I see why you're saying meaningless, but that says a lot about the state of the like macro market right now.
Yeah, I think we can debate how you articulate the disconnect from true value or whatever that means, but you're exactly right. That's what it says to me. It says it's people who don't understand. I think you have to hypothesize that people uneducated, maybe average investors might think that a stock that trades for $1 a share is a better value or a smaller company or something than a stock that trades for $100 a share or a stock that trades for $100,000 a share. We know that's not true, and I don't know if we want to dive into a little further explanation on why that is, but it's just another thing. Like I mentioned earlier, everything is screaming, this is crazy. There's no sense in the market right now.
So two things. I think one, last week we talked about Howard Marks, co-founder of Oak Tree Capital. I think he accidentally justified this.
In which book or writing?
In The Most Important Thing. Because in The Most Important Thing, he says that risk arises when markets go so high that prices imply losses. So, hear me out. Does that also mean that risk falls when prices go so low that it implies gains?
Oh, so you just joined the herd here. You're one of the crazies these days.
I'm just executing what I'm reading, bro.
I mean, a penny stock goes to zero just like other stocks go to zero, and it goes to zero a lot quicker in a lot of cases. We also exchanged some literature this week, right? Non-profitable technology index from Goldman at an all-time high, like a factor of 4 greater than what they've tracked previously. U.S. junk bond yield at all-time highs. I don't even know what to do anymore. I guess I don't know if I should decide to scream from the hilltops to try and save people that don't understand what's happening right now, or if I should just think about what it means for like my friends, family, colleagues that I help with some of these things. What are we supposed to do here?
I mean, I spent most of Q3 and all of Q4 last year screaming from rooftops and soapboxes, all the ones that were given to me, which are all in my home because we are in a pandemic. But so, and nothing's listening. I don't think trying to save the market is going to work right now. And if you recall, the Doogles indicator saying this isn't the year, although Doogles himself is saying this very well might be the year.
All right, so let's revisit that actually, if you don't mind. Switch gears. I'm sure we'll talk about overvaluations, not only in the rest of this episode, but in coming weeks as well. But you have a pretty interesting proprietary trademark. I think there's patent pending on this too. Doogles indicator, right?
The patent's so pending, it hasn't been filed.
For those who didn't listen last week, give us a quick overview, and I think we'll continue to check in here as your hypothesis forms. But talk to us about what you're thinking at the moment.
Yeah. So for one, I'll just say this is I'd classify this under the bucket of like academically fun, right? Exercise to kind of look at. So basically, I had this thought, and I said, what if we looked at how the average stock, or the median, to be technical, the median stock is performing relative to the market, right? And in theory, you should say that because if you look at all stocks across the market, that the median stock should perform against the market. Like it should be around one, like in theory, pure academic theory. And so I was just curious as to what that looked like over time. And what I found basically was if you look at what the median stock over the past like 50 years, what that was relative to the market and the change in it. So if you look at the last high to where it is, like what's that change? That there's an interesting correlation between the median stock performing at about half of what the overall market. So the median stock relative to the market is 0.5 and being at the top of the markets. It flagged in 1973, 1974, and 1987 through 90, which is interesting because that's a lot of years. And then in 2000, and then 2008, 2009. And so this year it started to spike a bit, right? But it wasn't quite there at the beginning of the year.
Yeah, so you said 0.5 might be a trigger. What is it now?
Right now
it's
like
it's
at
0.68.
It was at 0.68.
Okay. Oh, so almost 0.7.
Yeah.
So the Doogles indicator is not screaming overvalued. I mean, I think the best advice I've heard here is no one metric is the appropriate. There's no one predictor, but if you see 10 of them that are all saying something similar, then you start to make conclusions from that.
But it's basically just realizing the time that we're in. Going back to something you've said a lot, where you have to match the investment thesis, investment philosophy to the investor, right? And make sure that fits. I think just knowing what time we're in allows you to say, like, how do I want to operate in this time? Do I want to be more risk averse? Do I want to be more risk tolerant? Right? And I think all these indicators are just saying we are in a frothy place. Whether go ahead.
No, so the Skippy indicator is deep value screen, Ben Graham stocks, defensive investor stocks, chapter 14 of the Intelligent Investor. For those reading along at home, I run this every year for 15 years now. You're typically going to get somewhere between 10 to 30 stocks. I'd say average is maybe 15. I just ran it last week. Right now, there's one stock in the U.S. market that meets this screen. Right? How much froth is that? It's different than your metric. It's just your metric might have a gauge of the overall market. This is just showing you the bottom cheapest corner of the market, like how full that is. And there's one stock there. This is definitely a Doogles play because it reminds me so much of China Mobile. It's called Telephone Data Systems. Price to book value of 0.5. Like this thing is dirt cheap. I can bring up all the metrics if we want, but that is the Skippy indicator for the week, and it's things are crazy.
Here's what I think is scariest. If you go back, so couple things. Margin debt, right? Yeah. Highest $800 billion, something like that. Highest that it's ever been. Second is that person making their TikTok video, epitome of just like the market has gone insane. So those are two things. That is not my boy. No, that's not my boy. But so those are two things. Then there's I think it was 2 weeks ago, you were going through like the 10 fundamental indicators that all point to this is craziness, including CAPE, price to earnings, price to cash flow, everything. There's all that. But if you take the Doogles indicator and the Skippy indicator, right, and put them together, you know what that says to me?
No idea.
You can't read the mentals. So what that says to me is that the overall market, right, basically the floor, is overvalued.
Yes.
And we're not yet at the top. if you put those two things I'm just reading them purely. And if you put those two things together, mixed in with the margin debt and unemployment, like when this falls, it is insane. Like, because it's going to fall through the floor. It's going to fall through the floor.
But here's the deal. When it falls,
goose pimples.
when it falls, I'm going to be holding international stocks, I think.
What percent of your portfolio is international versus US?
Oh, Doogles, it's so hard. In my like boring retirement funds, 60%. In my more active investing, I'm typically US based if I can get value in the US, because the US has competitive advantages over the rest of the world, right? You know, like if you can find value in the US, it makes sense. But when the US is frothy, I think it starts to make sense to go international. So to build on this idea, if you're the people that don't know how to invest, if you've been telling them to buy target date funds like I have, in certain situations, and you realize that the real expected return is less than 2% there, I'm really struggling for the people that maybe don't understand buying international value stocks or buying factor-based ETFs, you know, like a more sophisticated strategy. I just really don't know what to tell these people, because odds are your average person, if they get 2% returns over like the next decade, are gonna panic and try and change their strategy at a time that's probably absolutely worse for them to do that, right?
Like this is a time period. I know we've discussed the like, do you throw it all in, or do you dollar cost average before? Like dollar cost averaging index funds that you buy every month, so you can average out the tops, bottoms. This is a time where I actually think dollar cost averaging makes sense.
Yeah. I mean, I think that's a reasonable speculation. Again, like historically, that hasn't been the case because the stock market goes up more than goes down. But historic valuations, right? I'm gonna go hardcore. Like I'm gonna dive into value stocks, both international and in the U.S. And one thing we could debate is like my typical strategy is buy deep value, and I'm perfectly fine with highly concentrated holdings. So if I get like 5 stocks that meet my criteria, I'm perfectly fine with the diversification that only comes with 5 stocks. I know most people should not be, but I understand the risk there. But when one stock meets my screen, I would like to pick your brain on the best approaches for diversification there.
Yeah, mine is actually simple and boring. So I actually have in my model, if 0 stocks, because there are some years where nothing has mapped it, it's very few. But if 0 stocks or just 1 stock comes through, I put 50% of that year's allocation in that stock and 50% of VTI. And it's more diversification than my model typically has, right? Because it's a concentration is actually a core part of the model. I only buy up to 6 stocks a year, but that's what I do. And it's for me, that's more of it's just a downside risk mitigator if that one stock goes wrong.
Wait. So when your screen only brings back 1 stock and you buy that in VTI, you still have a bunch of legacy holdings, right?
In theory, I should. But the thing is that because there's also sell criteria that fits into my model. So I think in your model, correct me if I'm wrong, in yours, you replace all stocks every year. Is that correct?
It's basically a rebalancing. Yeah.
So I don't replace all stocks every year. And so the way that mine works is if a stock starts to languish, or if a stock actually overperforms for too long, then it sells. All the value of that stock then gets redistributed. And so it could be a year where, just to make this up, let's say that I'm doing $1,000 a year, right? Let's say I'm throwing $1,000 a year in. It could be a year that I'm only investing $1,000, such that one stock actually would not be that big of a deal. But it could be a year where my largest holding, which can get up to 30-40% of my portfolio, that largest holding could have gotten sold because it was overperforming. And that largest holding could then be going into one stock. And that's the situation to manage the downside risk where I say I need to diversify. That makes sense?
All right. No, it makes perfect sense. So, and I like that philosophy. I try and keep it to 5. And so my question right now is, where only 1 meets my screen, I should I try and keep it to at least 5. What I've done historically, I think the least that have ever met the criteria is like 3. So I bought those 3, 20% each, and then I bought 40% of GVAL, right? Because it's a diversified strategy to buy
That's
international.
MEBS. Is that MEBS?
That's
ETF?
MEBS, right?
Okay.
Deep value. So, but
Meb
there's
Faber.
only
Sorry for those that aren't familiar. Meb Faber.
They're all pros by now. Doogles. So what I'm debating this time around is I will definitely get some GVal. I just don't know that I want 80% of my strategy for this year to be in GVal. I mean, I like it. I hold it in other things. I hold it in like my kid's college fund, and it's perfectly fine. But I do like the concentration that comes with US deep value. And so I'm considering stretching my criteria a little to try and take in a few more stocks that are still dirt cheap, but not like rigidly cheap. You know, like if the price to book is 0.17 instead of 0.15. Although that's not my preferred approach. What do you think about this?
I don't know. Do you really want to play around with that? I mean, it just feels like you're desperately seeking Susan right now. I don't know if you've seen that Madonna movie from the 1980s. Up to you guys. But no, it just seems like you're trying to find something to buy just to get the capital out there.
Yeah, no, that's so. I'm
next thing I know, you're going to be on TikTok.
In the TikTok video. Yeah,
yeah, exactly. I mean, yeah, I wouldn't start unless you've done it in the past, right? If that's a part of your strategy and models,
I've never wavered.
I wouldn't fluctuate then. I would just stick with it. I think buying just one stock is I wouldn't do that. I think you need to have something alongside it. The issue, I guess, is with GVal is it's ex-US, right? It's only international.
Yep. Well, no, actually, it's basically the 5 cheapest stock markets in the world. If the US was one of those, it would own US stocks. The US is just not going to be one of those anytime soon.
Yeah. When the US is on the global value ETF and that guy's on TikTok, we know the world is coming to an end. Like my gut reaction is that feels like you're buying cheap. Like, which as much as I call your model garbage, like it's not pure like cheapness.
Not
right. And what you're saying is, I don't know exactly what goes into what flags for MEB if it's purely cheap, but I think it is close to that. And you're saying like instead of buying deep value, you're going to buy deep cheap international.
So okay, here we go. GVal. Here's the fund statistics. Price to book value 0.9, price to sales 0.74, price to cash flow 4.9. You know how incredible that is? Price to cash flow of 4.9. Dividend yield 3%. Like that is again, I hear what you're saying about cheap versus value, but there's some value there. Let me pull up.
Is Poland in it? How much is Poland? 65%?
No. I'll get back to you on that. So here's another option, right? My boys at Alpha Architect run QVal, which is a quantitative value fund. This is US based. Now compare some of these statistics. Price to book 2.2, price to cash flow 5.9, dividend yield 1.4. So I can supplement with US only value stocks, right? But when I looked at QVal, basically QVal, I'd rather stretch my criteria a little, because if I stretch my criteria a little, I'm still getting more deep value than even QVal, the ETF, is at the moment. With GVal, though, that's dirt cheap all around. That's the cheapness I can't find in the US. And that's why I know my next rebalance will include a significant portion of GVal. I'm just not sure if it'll be 80% of what I invest.
Yeah. So two things, like zooming out, right? High level. Two things I would say is, one, I think it's probably worth just like sitting down and qualitatively writing out 5 bullets of, if you haven't, right, of like why you do what you do, right, and then see if it maps to that. That's the first thing I'd say. The second is the reason that or maybe a primary reason that I buy VTI in mine is because that's the benchmark that I look at. Like if I didn't have if I didn't build out my model, right, I would tell myself just to buy VTI, because VTI is the thing I'm trying to beat. Like it's my benchmark. And so basically I buy my benchmark if I don't have
my benchmark's Bitcoin, man. Like that's
you're losing out. You should.
I totally hear what you're saying, and so before like I poop all over it, like just I hear what you're saying. That makes sense. If because the FOMO aspect of investing that makes it so hard, which is a psychological piece, is like, oh, everyone else is making this. So if everyone else is making VTI, then that makes sense. But man, a lot of people that aren't you are going to have benchmarks that don't make any sense with that philosophy, right? Like my benchmark is not like Russell 2000 value fund, or I mean there is a lot of cheap crap in Russell 2000 value, like the stuff with no insight that just gets called value as an index is not value investing in my eyes. It's not like no brainer, like they have more assets than the actual current market value of their company, so it's almost impossible to lose money. Those are two different things. But I hear you. I just would caution people that aren't Doogles with that approach. Or maybe with that approach, you just say your average know-nothing investor should buy SPY and should do nothing else. And that's a reasonable approach. So I guess I can go both ways.
Yeah, I get that. And that's what not SPY, but VTI, which are very similar, right? Because like, I don't know what the actual number is, but it's something like 90% of the US market is the S&P 500 when it comes to market capitalization. It's something like that. And so it's a little bit beyond that, but I do think that the average investor should just buy the overall market. Like that is my, and so that's the thing that I positioned against, because it's hard to beat. Like the overall market is very, very difficult to beat.
I mean, for you.
You don't want me to pull up my multiples. All right. But seriously.
I know you have some fishbowl stuff.
We don't want to sit on this for too long, but we would be remiss if we did not go this week without talking about the fact that somewhere in rural China on a Zoom, Jack Ma made a quote unquote appearance.
All right. So Jack Ma, yeah, I mean, I saw a photo. I continue to be skeptical of anything related to Jack Ma, but this is the best story. I mean, my eyes just light up every time I see the latest tweet with some Jack Ma news.
I was just scrolling through books trying to figure out what I was going to read next and came across his autobiography. You know what the title is?
No.
Never Give Up. I was like, Jack, you're speaking to me from inside the cave.
So great.
Yeah, so we'd be remiss because we brought that up a couple times, but Jack Ma is apparently back somewhere. He didn't hold up a newspaper, but he was back somewhere.
And you never got your poop emoji either. So
no, I didn't. I did not. The other thing is in Howard Marks' book, the same one that we talked about earlier, The Most Important Thing, he brings up how like market performance, market prices result from a mix of psychology and then fundamentals or technicals. And I think that isn't rocket science necessarily. I think a lot of people, like if you say that, they go, yeah, sure. Like that makes a lot of sense. But when I started thinking about it, second order thinking, okay, I'm going to talk about my second order thinking.
Second level
thinking.
Yeah.
When I started thinking about it, I think it's really fascinating because in a lot of times you might look at different people's like investment philosophies or, risk tolerance and see them on completely different planes. But I actually think that one way to look at it is what percent of someone's philosophy is based on market psychology and what percent of someone's philosophy is based on market fundamentals. Does that make sense?
Yeah, no, I love this. So The Most Important Thing is one of my favorite books. I think it's just incredibly underrated, and it's the reason I have so much respect for Howard Marks, for sure. But if you go back to the TikTok guy, right? Like, as much as I make fun of the TikTok guy, momentum investing does work. It's worth understanding and exploring. And he doesn't, I mean, I'm not trying to rip on the guy, but he doesn't understand necessarily why it works, or he's not thinking about the psychological aspect of how he's been able to have a few decent months. But his methodology is almost 100% based on the psychological component, herd mentality of people buying things that are going up, right?
No, he doesn't have a methodology.
Okay. All right, that was a stretch.
No, yeah. Now I know what you're trying to say though. It's like the reason why he can make money, the reason why happenstance and luck has allowed him to make money right now is because of market psychology.
Yes, that's what I'm trying to say.
Yeah, he probably thinks it's fundamentals. Like it reminds me of when was this? I want to say it was like 10, 15 years ago in the March Madness, in the March Madness tournament for college basketball. Yeah. It was the year when there was some team that it could have been like VTech, or it could have been George Mason. Maybe there was like a team that had no business like going where it went to. Was that the same year that Bucknell beat Kansas?
Different year, I think. But anyway, George Mason was like a 10 seed and they went to the Final Four.
Something like that. But I think there were two things that happened. I feel like it was the year that Bucknell beat Kansas and then something else happened. So it might not have been George Mason. But someone in the ESPN bracket pool had a perfect bracket, right? And ESPN was interviewing this guy. And he was like, well, I knew Bucknell was going to take down Kansas because if you watch game 6 of the regular season, I was like, come on. Like, this is not, that is, if you ever have hindsight bias and you want to know what it looks like, listen to the interview with that guy. But that's exactly what this dude, he's going, like, if you ask him why he made the picks he did, right, he's probably going to bring up something about how Tesla, its current valuation around like in the EV car market, that's not what you should be looking at. You should be looking at when they have self-driving cars. And obviously that's going to, whatever. Come on, dude. Like, don't give me that garbage.
Oh, I don't know what to say to that.
Yeah. But anyway, so I thought that was really interesting. And it made me start thinking about the difference between like our models, mine being, as I call long-term momentum, and yours being more value, that mine plays a lot more into the psychology of the market than yours does. And implicitly, taking advantage of momentum, I think generally is saying that you're riding a wave of psychology in the market. I'm not looking at cash flow. I'm not looking at earnings. I'm not looking at anything. Like the only thing that I use to calculate are prices of stocks and then the returns that come from that relative to the market.
No, but as a thought exercise, this is so interesting because we debated earlier, like, is yours more psychology and less technicals or fundamentals? And is mine the flip side? Probably so. But there's an aspect, even though I'm heavily reliant on fundamentals and like deep value, there's still a psychological component in there because the core hypothesis of most value investing has to do with mean reversion, right? So it's like the fair price to book of this stock is 2, and it traded up to 3, and then it came all the way down to 0.7. Well, I'm buying it at a 0.7, knowing that I think it's going to head back up to 2 at some point, and I'm probably going to sell it when it gets to 2. So there's a psychological aspect to that too, potentially. Now you could just say, no, that's just going to true value. Like that's just, what something's actually worth, and that it's worth half of that now, and that's when you buy it.
I know we've talked a lot about like froth and bubbles this time around. So I'm going to throw out one lyric. Have you read Fooled by Randomness?
Yes.
Yeah. There was something I don't have the quote, but Taleb, who wrote Black Swan, also wrote this book, Fooled by Randomness, which is, he basically spends the book just trashing anybody that thinks that the market isn't random and that believes that they can have any sort of model effectively. He's a derivative trader, I think, by practice, but just a skeptic in reality. But I find it to be entertaining and also intellectually stimulating. He basically compares bubbles to Russian roulette. Let's say that someone says Russian roulette, if people don't know, it's a game. I don't know what you want to call it. It's a practice. But if you have, let's say you have a gun that has 6 bullets in it, right? But you just put a 1 bullet in, then you have a 20% chance, or whatever that is, little under, like 18% chance, whatever that ends up being, of getting shot, right? And he's saying, what if you played Russian roulette and someone said, if the bullet doesn't go off, you get $10 million, right? And so bullet doesn't go off, you get $10 million, right?
Yeah.
And if you compare that to somebody that does do something that's more methodical and gets $10 million, an accountant will basically say, well, both people have $10 million, so it's the same, right? But if you look in a bubble and you take TikTok guy, right, who's in his margin debt screaming from the rooftops about whatever size penny stocks he's buying, and he gets his $10 million, he's actually just playing Russian roulette. And the next time he tries that, you don't want to hit the death line.
No, so I mean, Russian roulette guy and Bitcoin guy are the same guy right now. Again, I understand the so-called investment hypothesis of Bitcoin. I strongly believe it's a speculation and not an investment. But let's use that same analogy, right? Two people with $1,000 make investments. One guy, 5 years later, has 40K because he spent it in he so-called invested in Bitcoin. Another guy used like Buffett style, quantitative, whatever, to get his investments to 40K. Well, when the bullet shoots or the wheel stops or whatever, right? The one guy has like ownership of real companies that build real assets or provide real services that pay dividends that have positive cash flows, that like he owns something. And I don't even want to, I'm not trying to piss the Bitcoin people off, but the other guy owns like some, what does he own? Some lines of code that other people believe to be value. He doesn't have a company. He doesn't have people working for him creating real value every day. I'll leave it at that. Again, I'm not trying to.
And he forgot his password. The strange thing is, when we talk in a week, you're going to be telling me you're Bitcoin guy. You're going to be like, I bought my one stock, and then the rest of it I split 50-50 between G Value and Bitcoin.
Obviously.
Password Doogles.